large business owners, we run risk mitigation strategies over and above their traditional commercial insurance, quite honestly, to protect their most valuable assets, which is oftentimes the revenue streams from their businesses. And there's some very tactical.
Yo, this is Christian D. Evans with Journey with Christian D. Evans podcast. Guys, thank you so much for tuning in and listening to our amazing podcast. This is where we reveal the top 1% of business concepts and systems and processes to scale 8 and 9 figure businesses. We interview top level 8 and 9 figure CEOs, business owners, and amazing TEDx speakers like David Meltzer. We got Nick Cavuto, Pascal Bachman, and so many others. And if you feel like this resonates with you, please share this with your friend, your family, and make sure you impact them as well, because we're trying to spread the message on those that do not know how to scale 8, 9 figure businesses and talking higher level business concepts. So guys, remember, enjoy the episode and be uncommon if you can. Cheers. Thank you so much for tuning into Journey with Christian D. Evans podcast. I am your host, as always, Christian D. Evans. Now, we have a very special guest on today because we always talk about being rich, right? And going out there and making a lot of money and cash flowing and whatever. And that's fantastic. But also there's an idea about wealth, right? Wealth management. And one of the things that I found, my next guest, we were just talking offline. He was basically explaining, because everybody has access to all sorts of different vehicles now, indexes and things that you didn't have access in the 80s and 90s. Well, now it's more about finding someone that has the advice, that has weathered the storms, whether it's ups or downs in the stock market, whether it's alternative investing or whatever it is, and be able to say, hey, you know what? I need someone's advice, almost like a financial planner, a wealth manager that can come across and say, hey, what is your aligned goal and how are we going to get there? And what's the vehicle that can establish that end result that you're looking for? And that's the reason why we actually have this next guest on. Now, he is known as a thought leader in the professional service industry based on his 10 years of experience owning and operating a multidisciplinary firm. Prior to starting his firm now, he spent his career as a wealth manager, investment advisor for a few of the most prestigious financial institutions. After years spent in the institutional space, he recognized the value of having tax, law, wealth management, insurance services all under one roof. As a result, he opened a registered investment advisory firm, a CPA firm, an insurance company. He also aligned himself with the sophisticated planners at Nelson Law Firm, now known as the Heritage Family Office. Please welcome the co-founding partner and CEO, my friend, Michael Frost. How you doing today, Michael?
Good, Christian. Thanks for having me.
Man, hey, I'm really excited about diving into this because, like I mentioned, one of the things you told me a little bit on top of mind a little bit is everybody's having, access to a lot of this, which is nice. It's decentralized. People are now having access to a lot of the markets that they didn't have before. However, though, that comes with the same mindset. People still don't know exactly what to do, how to anticipate it, how to build that infrastructure. And now it's really having someone that has, like I mentioned, weathered the storms. But before we dive into all that good stuff here shortly, which is going to be fun, tell me a little bit about that evolution, what you're seeing in regards to kind of the lay of the law of the land, the layout, the foundation, and seeing how, because of this access, it's been able to have these other, the demand for more knowledge on how to move your position or move this whole situation to position yourself correctly.
Yeah, I think you're seeing this, especially in the professional services space, really happen in all four primary lines of service: tax, law, wealth management, and insurance. You're seeing a lot of consolidation, and you're seeing clients having less value in the actual deliverable itself. Say take the tax world, for example, the actual deliverable of the tax return. It's been extremely commoditized. Or in the legal world, whether it's estate planning or entity formation, via the evolution of technology, clients have the access to form a basic estate plan by way of example themselves. I mean, they can go online and go to your do-it-yourself website and get some type of basic estate plan, and it goes on and on. Wealth management and insurance definitely commoditized. You've got a lot of investors that are do-it-themselfers now, and so I think the professional services world has really been forced to evolve. And our firm, luckily, I think we found ourselves ahead of the curve when my business partner and I, just a decade ago, were just business planning, and all we had at that point was a vision. We found ourselves well ahead of the curve. The ability to build a 100% vertical firm of having tax, law, wealth management, insurance, all under one roof is really where you're actually starting to see the industry go towards now. Whether you're an attorney working in isolation, or a CPA working in isolation, or a wealth manager, you're hearing from other thought leaders with inside your discipline or your peers to add on additional services to better serve the clients, because clients are seeking and they're wanting their most trusted advisor to have a vested interest in on everything that's going on now, just not within that one discipline like wealth management or like legal or like tax. Take CPAs, for example. Oftentimes, the client does look at the CPA as the most trusted advisor. And what we've found is they want their CPA to actually have a vested interest in what's going on across all their affairs: corporate governance, estate planning, wealth management, the selection of insurance, whatever it may be. If that CPA is the most trusted advisor, these clients want that CPA to have a vested interest. And so, if that CPA is not willing to evolve their practice into other lines of service, honestly, they're at risk of being extinct. And you're really seeing that in the CPA industry right now because of the consolidation that's taken place.
So this is interesting, and I want to understand a little bit about kind of your guys' play when you were playing this out a little bit. Was this more of anticipation? You saw the trajectory? Because I want to acknowledge that yes, there has been more information available for everybody, which is a good and bad thing, right? It's almost like going to Google and saying, "Hey, you know what? I've got this pain in my elbow. Oh crap! Now I have cancer," right? And the reality is, no, that's not true. In the same way that people, yes, we have access to this information, we could build this stuff out, but it doesn't mean that we as individuals that have built a business or et cetera, we don't know the law, the CPA, the tax law, the whatever, the wealth management, the styles, the different vehicles, that it's very intricate detail. Am I thinking this thought process correctly in regards to kind of the way to think about this?
Yeah, you are. And before we started Heritage Family Offices, when we were just business planning, envisioning what this company would look like, and I would encourage your guests that listen in that are entrepreneurs, the exercise that we did that's clearly paying dividends now is we didn't look at our competition. I think what a lot of business owners, especially in the professional services space, and especially if you're just getting started, you want to look at that guy in the corner office that's having success. So they'll go study, who's having success in this industry, and they'll try to replicate whatever that individual is doing. They're going to say, "Hey, I'm going to do what that guy's doing, but I'm just going to do it a little bit better. I'm going to work a little bit harder." That is what we did not do. So instead of looking at our competition, we looked out into the marketplace and we said, "What's missing? Who's our client? What could we build that's missing in the marketplace?" And now it's in the name of our company, Heritage Family Offices. But back then, which that term is thrown around really loosely now in the professional services industry, but back then it was less common. And what we focused in on was not our competition. We said, let's look at the marketplace and which clients are underserved, which clients don't have access to a family office. The coined term family office came about from the ultra affluent who had the ability to basically put their attorney, their CPA, their wealth manager, their insurance, and any other professional they wanted on staff, only working on their affairs. That's where the term family office came from. And we said, let's bring it, our licenses between myself and my partner as an attorney, a CPA, financial planner, and an insurance professional. Between the two of us, we had the licenses to provide that service, but let's do it for the affluent, the $50 million, $100 million client, not the half a billionaire, the billionaire that already had the family office. And let's bring that service to the marketplace. And that's where we found ourselves wildly successful. And arguably, it was not because my partner was the best tax attorney. I was not potentially the best financial planner. It's because we brought something to market that wasn't there. And so that's what I would encourage you and any of your listeners when it comes to starting a business. Don't necessarily look at the professional as having the most success and try to replicate that. Instead, focus in on the marketplace and what could you bring to that marketplace to get yourself into a place where there's no competition, or at least a lot less competition, because every single line of professional services is a very cutthroat industry. And so we just brought something to market that didn't exist, and that's what really launched us.
This is incredible. So now we're talking about legal services, tax planning, insurance planning, and wealth management. Those four kind of pillars. Now, Michael, I want to ask in regards to like onboarding someone, right? Because you have it all in house, right? And what's so beautiful about this, they can all talk, and you guys are all aligned. All those professional individuals are all aligned on that one person's journey to wealth management, whatever that is, right? Preserving that capital or that legacy, et cetera, right? So my question is, what does that look like for you guys in regards to Heritage Home Office? What does that look like? Unpack that methodology when you're able to help them say, okay, we got this all under one roof. Now we can align that. What does that look like in, maybe bringing someone on board, understanding their risk mitigation, understanding their growth strategy, understanding, what is their ultimate goal? What does that look like?
Yeah, it's different today than it did our first few years in practice. Something we learned the hard way, and even to this today has been a professional mistake, is our value proposition became so valuable that getting new business became extremely easy. And the professional mistake that we made is we said yes to clients that should never been a client of Heritage Family Office. Just because we had the capabilities of preparing their tax return, doing their legal work, providing insurance and wealth management solutions, and doing it all under one roof doesn't mean we should have said yes to them on onboarding them as a client. And what happened was we grew to the size that we almost lost our identity, where we were a family office, but I was promising something that I necessarily couldn't deliver on. And we grew to the size of about 1,000 clients. And it's when we recognized that we could not be all things to all people. And so since then, we've really been segmenting our practice, whether that meant divisions with inside our own firm and or potentially selling off clients that arguably should have never been a client of the firm to begin with. And so as we sit here today, we do a deeper due diligence on our new clients than we ever used to. This needs to be a mutual fit because of our business model, we know our clients intimately. We prepare their taxes, we do their counsel, any and all transactional legal work. We manage their wealth, we build their financial plan, and we provide the insurance solutions. We oftentimes know our clients better than they know themselves. That being said, we also pass on a tremendous amount of economies of scale to the clients. Because we try to price our engagements with the clients very custom so that we do pass on some economies of scale to the client. So now we do have practical minimums in place. Typically, we're not engaging a client unless they have 5 million of assets managed at our firm, and it usually starts with wealth management. And so, and then from there, we can pass on those economies of scale through our law firm and through our CPA firm. And so, we engage an exploratory relationship with really no commitment to the client. It allows them, if we're going to have that intimate of a relationship with the client, they have to like us, they have to enjoy us. They've got to be willing to really share everything. And once we gather that information, then we'll put a custom engagement letter that usually encompasses all disciplines. And it's usually a mutual decision by the end of it. The client needs to say yes, but then Heritage also needs to say yes. And our commitment to say yes needs to be a promise that we can actually deliver on a full multidisciplinary service to the client. And again, we kind of learned that the hard way because we got away from that when we actually grew too big in clientele. And so we stay fairly disciplined. It's got to be a perfect fit, but it's usually what we define as a middle market client, somewhere between 25 million and 100 million of net worth, a lot of concentration in a privately held or a closely held business. And they've got the same type of complexities that the ultra wealthy have, the quarter billionaire, the billionaire, same types of complexities, slightly lower numbers, but let's be honest, I mean, it's still a significant amount of wealth with a tremendous amount of complexities that they need all the services under one roof. And we can usually take better care of that client than any other firm on the street because they don't have all the capabilities in-house.
I like that you really do a filtering process. It has to be a synergistic relationships both ways. It's not just acquiring clients just for the sake of it because they got money. Cool, let's help you. Now, I want to ask you, Michael, because I would imagine some of these individuals have probably have worked with CPAs or individual lawyers or tax consultants for maybe individualistically, or they came across you and said, "Hey, this is a holistic picture. Let's do this. Let's make this happen." I don't know if you can share a case study or maybe maybe overarching a story or something like that that could help me understand a little bit about some people's experiences where they came from that kind of individual kind of categorizational approach to more of that holistic approach with heritage family office here.
Yeah, and this may be surprising if there's any professionals on the line. And I learned this firsthand when and the name of my business partner, his name's Ralph. He's duly licensed as an attorney as well as a CPA. My licenses are on the other side, and maybe I should even update my bio because even since then, Arizona just became the first state to allow non-lawyers to own a law firm. So now, even though I'm not an attorney by background, I do own a law firm. So maybe we can talk about that at a future casting. But what's taking place in the legal space is interesting. But one thing I learned about working with CPAs and attorneys is prior to working in a multidisciplinary practice, I was always intimidated by primarily the CPA. I think they have the reputation of technically knowing it all, being that smartest person in the room. And I was lucky enough to find genuinely, and I'm biased in this comment, one of the smartest, most technical practitioners I could ever partner with. But I found out working alongside them, because the CPA industry is such a time-intensive practice, they don't have much time to sharpen their technical skill set sometimes, and so I found out they don't know it all. In some cases, it's quite the opposite, and I spend a lot of my time now training and consulting other CPAs around the country, even though my background, I'm not a CPA, but I was willing to invest myself in the discipline. And I think that translates to your original question of how do clients relate to this, or give me an example of how a client transitioned from a sole practitioner to a multidisciplinary practice. Oftentimes, it is triggered by the client firing their CPA because their CPA did not bring something to the table. I mean, clients, unfortunately, and this is what's happened in the industry and why you're actually seeing the CPA industry literally die. It's becoming a dying profession, is for exactly that. It's become such a reactive relationship with the client. Client goes upon, the business owner does what they do throughout the year. They gather all the information. The year is now passed. Whatever the results of that happened, they give it to their CPA. The CPA crunches the numbers, and the CPA tells them the results. You either owe this or you're whatever the outcome of the previous tax year was. And there was no proactive planning that was done. What our firm takes pride in is actually being proactive throughout the year, because once the year passes, there's not much planning or there is some planning that can be done, but the most impactful planning that we can do is during the year. So clients will fire their CPA because of an idea that we brought for them that they could have been doing year over year over year for the past 10, 20 years, leaving hundreds of thousands of dollars of tax savings on the table, simply because their CPA was so busy that they weren't willing to be proactive in the relationship. I learned that through partnering with the CPA on how much CPAs, for the most part, just they don't know. The clients are trained to just think their CPAs know everything, and they really don't. And it's because oftentimes they're hostage to their own practice, and they don't have the ability to go be forward thinking and invest themselves in new modern tax planning strategies and what have you. And so oftentimes we're picking up clients simply because we're just willing to be proactive, and we've built our firm that way, versus the entire industry that is really a reactive relationship when it comes to managing the client.
It's such a good example, and I'm glad we went this way because I actually fell into that situation specifically. I remember I was with a CPA, I sold my business, and I thought he was good, but what I realized was he was just very kind of year on year. And in fact, I was talking to a lot of my friends, and they were giving me these ideas. I thought, oh, I was the one that was bringing these ideas to my CPA and say, hey, why don't we do this to mitigate, risk, or do this, or et cetera, right? Whatever that strategy was. And I started realizing that, oh, wait a minute, this is the wrong CPA for me, because if I have to be the one that's bringing this up and he's not, forward thinking. And that's one of the things that caught me caught my eye on your website. It says RCPAs focus on your needs today while planning for threats, opportunities, and concerns in the future. And I just thought that was beautiful how you, like you just mentioned, in regards to, hey, not only are we looking at, yes, we're mitigating the loss, we're looking at tax advantages, whatever, but we're also like, hey, what are the opportunities here? Let's look out 12 months, 24 months. Like, what are you guys doing? How can we allocate this accordingly, et cetera, et cetera. And I do know that, like you mentioned, Michael, tax law and everything is changing all the time, depending upon obviously what political office is, who's running the political office and in the political world right now. But I want to unpack this a little bit, and I want to ask you, because I think there's a lot of my audience that have maybe had an exit strategy or something like that, and maybe they're looking to maybe selling their business within the next 12 to 24 months. And there's a lot of these questions that people need to have. Maybe they're newly founded, kind of wealthy, right? They got 5 million, 10 million. What kind of questions should they be asking when they would like reach out to you? What kind of questions should they be reaching out? What kind of questions should they be understanding, or help them understand? Okay, hey, okay, in order to make sure that they have the right process, because the reason why I'm bringing this up is because there's a difference between growth and preserving your wealth, right? Growing your wealth and preserving it. And I just want to explain that paradigm for our audience.
Yeah, anytime you're accumulating wealth, and especially when it has concentration in a small business or something that's going to have a liquidity event at some point in the future, you have to be proactive in the planning. I can't tell you how many clients come to our firm when it's just too late. The most impactful planning that you can do when accumulating wealth and preparing for a liquidity event, whether that be the sale of a business, an appreciated piece of real estate, a concentration in a portfolio, whatever it may be, the planning that's going to pay off the best is the planning that we can put in place months, in some cases, a year or two in advance. Matter of fact, there are even some limitations. There's something called the step transaction doctrine that essentially is law that's in place that if the planning is not done far enough in advance, that it can be simply unwound. And so you need to be mindful of just law that's in place, and be strategic enough and thoughtful enough to put the right times and plan in place, because oftentimes clients will come to us and they're looking to sell an asset, but it's already under contract to be sold. Our hands are pretty much tied at that point. At that point, we're doing after sale planning, meaning let the sale take place. We'll deal with the taxable event afterwards, and we'll do our best just to chip away at it. But if you really want to be extremely impactful from a tax planning standpoint, get far ahead of your liquidity event. So far ahead that you need to be mindful of what type of entity are you setting up to found your company. There are some entities that are much more tax efficient, in some cases completely tax free, when it comes to the sale of a business, for example. Well, you need to be so mindful of that the day that you establish your company. And so oftentimes clients think of tax planning or planning when it comes to the actual sale is already either under contract or already taken place. And at that point, you're not going to find a tax attorney out there that can do much for you. So if there's any advice that I could give to anyone that is accumulating wealth, and oftentimes accumulating wealth comes with concentration and preparing for the sale, is just get well ahead of it, because we have so many tools in our tool belt when it comes to pre-sale planning. If you can get months, or in some cases a year or so ahead of the sale, when you get down to weeks, it's too late.
Yeah, that was my first exit, and so I got hammered.
Yeah.
It was not good. So you're you're preaching to the choir. I appreciate you sharing that. That's why I brought Michael on, because I think it's so important for my audience to hear that, because you really don't want to be in that situation, and nobody really tells you this stuff until you're in it, and you're like, oh crap, you got handed it. So appreciate bringing this up. Now, let me ask in regards to kind of building this. And I always think about growing, like offense is as good as your defense, right? And definitely when you're in a situation where, okay, and this is, again, a really good perspective, because it's like if you had $100,000, you lost 50. Well, now you have to almost get almost 100% growth back just to get back at the ground zero, right? And a lot of people don't understand that. And definitely entrepreneurs like myself, I'm very guilty of this. This is the reason why I bring it up. I think very aggressively, and I think that's my growth strategy. A risk tolerance is relatively simple. However, though, I also understand, because I'm that kind of my personality. I also understand that I have to have some risk tolerance, risk mitigation, if you will, certain criteria that helps me make sure that my wealth is sustained in a situation where, hey, if this happens, then we're going to go ahead and mitigate our loss. And the reason why I'm bringing this up is, and I always love to share this story. When I was, selling, trading stocks when I was like 18, 19, I always had like, okay, when it would go up three points, I would take 80% off and then 20% let ride. And the reason why is because then I would be able to, access my wins. However, though, if I lost by 1.5 points, naturally what would happen is I would mitigate my loss and take it all my position off, right? Even if the stock would go back up. And that was with, momentum trading. And I think I just want to get your perspective in regards to when you're working with these, 5, 25, 50, $100 million families. Okay. What does that look like in building not only the aggressive growth, being able to preserve, but also building that defense? I know there are certain vehicles that can help you establish that. I want to just talk a little bit about that, Michael.
Yeah. So for most of our clients that because we cater to the business owner, most of our clients are self-made entrepreneurs. We have a very, very few clients where it's just multi-generation of wealth that was passed down. So in most of our clients' cases, clients, they made their own success and accumulated their wealth before our paths ever crossed. So when it comes to managing risk, oftentimes the greatest concentration of risk is actually within the client's own business. A very common kind of net worth profile, if our client's worth 100 million, 75 of it, 50 to 75 of it is actually in the business. And so oftentimes when we're looking for risk mitigation, and this is where probably we're different than your traditional wealth management firm. I mean, there are very good insurance type policies and strategies. And yes, we do leverage our own insurance company to insure our clients' risk in those what I would call traditional manners. And that's the clients still value that. Where we take more of a holistic approach is let's manage the greater risk, which is the concentration in the client's business. And so there's even section of the tax code that even applies to this, that for some of our large business owners, we run risk mitigation strategies over and above their traditional commercial insurance, quite honestly, to protect their most valuable assets, which is oftentimes the revenue streams from their businesses. And there's some very tax efficient ways of doing so and some benefits that come along with it. But we focus in more on that than we probably do just traditional life insurance and any other gap analysis that you could do on the client to kind of ensure any gaps that they may have. But oftentimes we're focusing in on ensuring the client's riskiest asset, which is oftentimes their own business.
So the concentration is one of the biggest things that a lot of my audience should be aware of, because that's where majority of their assets are a lot of times. So let's say, for example, you want to, we've heard about diversification. So in this situation, because a lot of our audience are business owners that are in that situation where it is very concentrated, their wealth, how would you recommend maybe diversifying their portfolio in different other vehicles? What would you suggest? And again, I know this is contextual depending upon that person's situation, but I'd love to maybe get an overarching idea.
Yeah, I mean, I'll tell you how. This is how we get to the end recommendation for any client that we determine that, they're over allocated anywhere in their life. It could be in, real estate. It could be, to use your example, they could be exposed in a certain area that they could get insurance for to fill that gap, or, whatever it may be. Clients should beware of anyone that's providing them counsel that has not done their proper due diligence. And so what we take every single client through is, and if they're not willing to go through this exercise, oftentimes we're not willing to give them counsel, no matter the size of the opportunity. Because if we don't do our deep due diligence on a client, how are we going to provide prudent counsel? So if a client comes to me and shows me just one of their brokerage statements and says, give me some recommendations off this, I'll slide the statement across the desk and say, I don't have enough information to give you counsel upon this. And so we want to know everything about your assets, your liability, your income sources, not just now, but look into the crystal ball and as far into the future as you can predict. We want to know what your income looks like going forward, and then most importantly, what are your objectives? What's most importantly? Is it family? Is it legacy planning? Is it philanthropic desires that you have? We've got to go deep into every objective in your life. Once you give us the answer to all those questions, I will give you very specific recommendations from a tax, a legal, a wealth management, and an insurance perspective. And one of those will be a proper allocation to your liquid net worth. So we'll get there, but without going through that exercise, arguably no professional should be able to give you prudent counsel if you're not willing to disclose all of that information.
Gotcha. That makes perfect sense. Now, I want to ask just kind of a personal question. We understand in real estate is one of the best vehicles to be able to like decrease that taxes. Now, I know each contextual, individual that you have, each person that you have that you work with, a client. Do you recommend real estate as an asset class, regardless of whatever they're focused on? Very similar to almost like an index fund, because of course we understand the power of the index fund, et cetera, et cetera. I'm just curious.
Oh, most definitely. Where we're maybe different than your wealth management firm across the street is our holistic approach to managing wealth. So oftentimes if you find yourself meeting with traditional wealth, and this isn't necessarily beating up my peers. I mean, there are good financial advisors at the big wirehouses, the Merrill Lynch's. I came from Merrill Lynch. So, I mean, the Merrills, the Goldmans, the Morgan Stanleys. The difference is you're oftentimes going to get very narrow counsel. They'll give you recommendations specific to their expertise that usually falls in the world of traditional asset classes. Where we're different, we are registered as an RIA, so we are a fiduciary. We do have the ability to manage portfolios, and we do. The majority of the wealth that we manage is in a very similar to the Goldman Sachs of the world. The difference is we're also a full multidisciplinary practice that should view the lens of wealth management through multiple different angles, that being non-standard asset classes, private equity, private real estate. And of course, if you look at all of our clients that have a significant net worth, they accumulated a portion of that worth by having some allocation to real estate. Real estate is a very tax efficient asset class. It can be a way to preserve and grow your wealth and generate income in a very tax efficient manner. And so, yes, we do recommend real estate. Now, it's got to meet the client's investment objectives and their goals. And do they want to be hands on or do they want to be completely passive? There's no right or wrong answer to that question, but real estate usually has a place in every one of our clients' portfolios. And depending on how much, really depends on how much concentration in real estate do they already have via rental properties, commercial properties that they have. even their own primary residence if it makes up a significant portion of their net worth. And so that oftentimes plays a factor in regards to our recommendation. But we're absolutely biased towards real estate in some form or fashion.
Well, I appreciate you sharing that because I think it's so interesting how accurate or how often there are certain vehicles that are almost common denominator in almost every wealthy individual's portfolio. And I've noticed real estate is a constant common denominator of a vehicle, whether, like you mentioned, the dilution of that, whether it's 3%, 5%, whatever that percentage of that portfolio is. But there is a lot of times there is that percentage. Michael, I really appreciate you being on today, man, just unpacking this high level stuff. This is really, really good. For those that want to learn more, want to consume more of your content and reach out to you, ask more questions, how do they do that, man?
Yeah, you can just go to our website. It's www.heritagefo, like family office, heritagefo.com. And you can find your way to anyone. You can find the way to myself or anyone else on our team.
Awesome. And those links will be in the description below. So make sure you stop what you're doing. And again, here at Journey with Christian Evans podcast, we always talk about taking action. So if you sat there and you're like, okay, I just had an exit, or we've got some things going on with some deal acquisition, whatever it is, and you want to start having those conversations, you better do it before than after. Because like Michael was talking about, hey, there's like, just like playing football, there's quarters, right? And we can focus on the third quarter, the fourth quarter, or we can focus on, hey, how are we going to play this out and figure out the whole game and really have a strategy and tactics, a way of doing that. And Michael's office is very, very familiar with this. So those links are in the description. Now, Michael, I always love to ask my guests before I let you go, is there any last words of wisdom that you'd like to share with our audience?
Yeah, I mean, it's 12 years growing this business. It's been fun, but speaking to the business owners out there, especially ones that working towards an exit, I think the story builds maybe just a little bit of credibility that we had to give. We've had our successes but we've had our failures too. And I think it's our failures that oftentimes give us even greater credibility than our successes. I was acquiring CPA firms early on in my career. And I think what we built today, I am so proud of. But it's gone through season of falling on my faces, making some big mistakes, brushing myself off, and keep pushing forward. And I think that's what's kind of built us to who we are today. And so I think just sharing our story and sharing our track record builds a little bit of credibility to that.
Yeah, it's just incredible to see what you've been able to do to pivot so quickly and then now have this amazing multidisciplinary office and be able to impact so many clients. Guys, that is the co-founder, partner of Heritage Family Office, my friend, Michael Frost. Guys, that is Journey with Christian D. Evans podcast. Until next time, be uncommon if you can. Yo, this is Christian D. Evans, Journey with Christian D. Evans podcast. We thank you so much for listening to this amazing episode. If you feel and you know that this was valuable to you, please show some love to our amazing guest by liking this, by commenting on this, by making sure that you do a nice 5-star review and just show some love to our guest. That'd be really awesome. Also, make sure you share this with a friend, a family, a colleague, someone that you believe would bring value to their life right now. And guys, we just want to say thank you again for just being part of our community. If you want to have more resources, don't be afraid. Go to christiandevans.com. You can actually schedule a phone call with me, or you can send me an email at christian.evans@beUncommonIfYouCan.com. That's christian.evans@beUncommonIfYouCan.com. Always love to hear some feedback and let me know what is the number 1 or 2 things that you are struggling in your business and your life, and we'll make sure we have those conversations. Guys, that is Journey with Christian D. Evans podcast, and until next time, remember, be uncommon if you can. Cheers.